Good day, ladies and gentlemen. Welcome to the Texmaco Rail and Engineering Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Naveen Agarwal, Head Institutional Equities at SKP Securities Limited. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. It's my pleasure to welcome you to this earnings conference call on behalf of Texmaco Rails and Engineering Limited and SKP Securities. We have with us Mr. Ashish Gupta, Managing Director, along with Mr. Ravi Verma, VP Corporate Affairs and Company Secretary. We'll have the opening remarks from Mr. Ashish Gupta, followed by a Q&A session. Over to you, Mr. Gupta.
Good afternoon, and I welcome all the investors and shareholders in the investor call.
Call recording has now ended.
So let me start by summarizing the financial performance of the company. Basically, we ended the quarter with almost 480 crores turnover with an EBITDA of around 45 crores compared to a gross revenue of 463 crores in comparable quarter last year. And there's a slight drop in EBITDA, which was 54 crores last year. This year is 45 crores. So this is on the financial numbers. The 9 months up to December, gross revenue is 1196 crores, and EBITDA of 130 crores, compared to a revenue of 1100 crores and EBITDA of 85 crores, which was last year. So first 2 quarters are quite bad because of COVID, oxygen shortage. There was a lot of problems due to, I would say, climate change because of excess rainfalls. The entire city was waterlogged, which impacted operations. Then there was a very unique situation where the only supplier of rail wheels to the Indian wagon industry went down to 2 months, and the entire industry suffered for 2 months where we could not produce enough. So, in a manner of speaking, very, very difficult 3 quarters for us. We are beyond our control. But still, we have been able to, do a lot of work within our various divisions to improve the performance. Also, we are all aware of the impact of steel prices and various commodities, which has been, impacting all the industries very adversely. So we were also not untouched by those price increases. So, this is in a nutshell as to what happened in terms of the operating performance across various divisions. So this is as far as wagon manufacturing is concerned. Then, if you look at our business of EPC, which is erstwhile Karindi, there were disruptions earlier in the year because of COVID. We had to demobilize the sites. Mobilization of sites happened, and then we had a very good quarter this year. Last quarter was very good. We touched almost 200 crores revenues on the EPC business. So it came back very strongly, the entire EPC business. Steel foundries, a lot of orders we have for exports, but impacted by shortages of containers, as you're all aware. The shipping prices and shortage of containers is impacting all the exporters. But we had a good overall performance in the company. Going forward, the budget has been extremely encouraging, very, very encouraging budget, and we see a lot of traction already in the market in terms of what's happening with the current inquiries and what Railways is going to order. And so we see a lot of announcements which have happened. There's a very large outlay for capex. Not only for railways, but also for other infrastructure segments, which is further going to actually drive investment into railways. So very, very upbeat about the announcements made in the budget. So this is a very small summary of what we have been doing in terms of the operating performance and a very slight small glimpse of what the outlook for future looks like to us right now. Where is he?
Nareshji, that's it from our side. We can now open for the question answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Pankaj Rawal, Ace Lansing. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question is, so can you give any long-term guidance? Of course, I'm not asking for any quarter guidance. So within next couple of years, maybe by FY25, how much will be revenue and any margin guidance? And my second question is, there is a high receivable level. So any reason for that, and what are the steps taken by company to control it for the net working capital cycle? Thank you. That's it from my side.
I did not get the second part of the question.
So the receivable levels. So receivable levels are pretty much high. The debtors outstanding. So any specific reasons for that, and any steps taken by company for the controlling it?
You're talking about debtors or debts?
Debtors. Receivables.
Okay. Okay. So I'll take both the questions simultaneously. So on the first one, in terms of outlook, I just informed a little bit earlier that we are expecting very large orders from railways and the private sector, and there's a very large capital outlay, and I think there should be very strong volumes for the wagon industry, and also the plants which have been announced for various metros and railway expansion should be a very strong demand for EPC business also. So that is what, as far as the demand is concerned. If you look at the debtors, we have a lot of projects which have been continuing for a very long time. Because in EPC space we have a lot of projects which extend up to 8 years, 10 years, etc. And so those projects typically have these issues with payments and receivables. So but this is normal, in long term, with projects with large gestation period. This is something which is not very abnormal. But we are making efforts to bring it down to reasonable levels.
Okay. And any guidance on margin, EBITDA margin, what the sustainable EBITDA margin going forward?
I don't think I can share that, in an investor call like this because
Okay. No problem.
Not permit.
Okay.
But I would say that the market looks good. We are doing a lot of work on cost reduction. We have appointed external consultants who are working with us right now to improve performance. And so we expect to improve our margins going forward, so that is what I can tell you.
Okay, that's fine. Thank you.
Thank you so much.
Thank you. Our next question is from Subrata Sarkar with Mount Infra Finance. Please go ahead.
Hello. Sir, can you give a breakup of each segment order book, like what is current order book vis-a-vis maybe 12 months back, sir? And out of which, how much have we executed in last 12 months?
Yeah. So our current order book, I will first start with the gross level order book. The gross level order book is close to 2,800 crores, out of which if you go to segment-wise, so steel foundry is around 150 crores, the rolling stock business is 570, The hydromechanical equipment business is 350 crores, and on EPC, our order book outstanding is close to 1,500 crores.
Okay.
So
And
we
sir,
started the year with an order book of approximately 3,400 crores. We are back to a 2,800 crore order book, and we expect to go very closer to the order book position of last year as we close Q4.
no, sir, I'm just trying to know, like EPC current now we have got 1,500 crore order book. So if we take vis-a-vis last 12 months, so what was the order book, and out of which how much we have executed in last 12 months, sir?
Okay. So if you look at our EPC business, we have total order book of 1,530 crores, and last year we had approximately the same level of order book. And this year's execution has been just hold on. It has been just give me a sec. So this year's execution has been approximately 400 crores
in 9 months.
in the 9 months.
Okay. So we, sir, let us assume that we have got new order of 400 crore in last 9 months, and we have executed around 400 crore.
Yes,
Is it
we have
right
got, between 300 to 400 crores. These are approximate numbers. If you want, I can give you the.
No, sir. I'm talking about approximate number only. Sir,
Yes. So we have got new orders also. Yes.
yeah. So can you throw some light, like what is the current debt situation as well as what will be the working capital net working capital situation, sir?
So our
And particularly
current,
after the repayment, like right issue.
I will. Our current debt is approximately 700 crores, out of which out of 675 crores, out of which long-term debt is 25 crores. Balance is all tied up in working capital.
Okay. Sir, like now we have done the like right issue, and we have repayment partly like ICD and ICD. So now our balance sheet is relatively have more strength. So are we looking for like replacing this debt with some lower cost debt, particularly giving the environment like now interest rate is quite low?
Could you repeat your question, please?
No, sir, I'm just asking, sir, now we have done our right issue. So now some fund has come into our like company, and because of that, sir, our debt, working capital debt has also come down to some extent. Now residual debt which we have, like it is like around 14-15% of cost, sir, around. So are we thinking of replacing that with some low cost debt, sir, which will help us to save the interest outgo?
No, see, most of the debt is, is with the banks. So we are already on a good interest rate, and earlier we had high cost ICDs which have mostly been replaced.
Okay. So now, what will be our current cost of sir, working capital or total debt, sir? How much will be the interest rate for that, sir? Yearly interest rate or cost of funds, sir?
Annual interest cost. See, I'll tell you the interest expense we have, which the finance cost, which is already published, is around 25 crores per quarter. So, but this will go down from next quarter onwards because of the rights issue.
Okay, sir. Any ballpark number, sir? How much it will save cost now from next quarter onwards, sir?
So I would say the reduction because of rights issue in the interest cost would be in the region of approximately, I would say, 12 to 15 crores. So on a quarter-on-quarter basis, around you can expect 3.5 to 4 crores of reduction.
Okay, sir. Great, sir. So just one understanding, sir, like for DFC, we require like flat wagon. So are we into that business, sir? And if it's so, then what can be the opportunity size for us, sir?
Which type of wagon are you talking about?
Sir, for DFC, sir.
Okay. So for DFC, typically two different types of wagons will be used for carrying containers. and we see a lot of demand from the market right now already. Not only Concall but other private sector players in the container train operator space are already ordering a lot of these rakes because a lot of freight can now be containerized and moved faster on rakes. So that's already happening, and we have also logged in a lot of orders for these wagons, and there is going to be a very, very good robust demand for such rakes now.
Okay, sir, perfect. Sir, now one question on the defense side, we had some. Yeah. Sir, just update from your side, sir. Our Bangladesh, this Agartala Aqua project, is it complete, sir, or is it like what is the status, sir?
Likely, we should be able to finish the project next quarter.
Okay. In this quarter, sir, we will be able to finish it, sir.
Next quarter.
Next quarter. Okay. So, sir, you are talking about 3-4 projects in Bangladesh. So, apart from this, which are the large projects, sir, and what will be the order size there, sir?
No, there's only one more project in Bangladesh, which is another track linking project between Kudora and Shahbazpur, which is around 450 crore project, and this project is slightly delayed for various reasons like land access, corona, etc. So we are currently negotiating a revised completion time schedule for the project with the Bangladesh Railways.
Yeah. So when we are expecting to complete this project, sir?
End of 2023.
Okay, sir. Okay. 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 So just since it's a international project, sir, so whether the payment terms and all those things, whether it is favorable to us, sir, we are being able to, or major part of the receivables are, sir, related to this project?
No, these are all Indian government funded projects, either through a grant or through exit line of credit business. So those issues are not there.
So there is no receivables issue on the. So what is our total receivable in that case, sir?
Total receivables, total trade receivables is around 630 crores. Total. Hello.
Mr. Subrata, this is the operator. If you have more questions, please join the queue afresh. Thank you. Our next question is from Vikram Kotak with Ace Lansdowne. Please go ahead.
Yeah, thank you so much. Thank you, Ashish, for taking my question. My question is the broad strategic guidance or direction of the company for, say, over the next 3 years, since you took over as a CEO and MD for in recent times. And we've seen in the past because of the government orders and the market situation, the numbers are very lumpy, either or either you have a lot of volatility in the EBITDA and margins and all that. So how do you see the glide path over the next 3 to 4 years? What are the key strategic priorities of the company in, say, next couple of years or maybe 2-3 years? Thank you.
Thank you. It's a very wonderful question. I think, as you said, lumpy and patchy, and for various reasons beyond, I think the last 2 years have been lighter for most of us. Right. But, with this new thrust on investment and government, actually, Indian Railways actually is looking at a 3-year plan and a 5-year plan, right, which is quite robust. So I would say, that would form a very, very, solid base, and that should give a very, very stable operations, to the factories and to various businesses. Over and above that, we are very focused on the export market now. So we have now, bagged 200 wagon orders from Africa, 3 countries. Yes. So we are actively, strengthening our design capability to be able to actually tap the new frontiers, basically, which is going to be Africa for us. Right. Very, very focused on Africa right now. So in terms of product strategy, I would say, we are trying to create a niche and try to rationalize our product mix, getting into new designs to cater to, the new customer requirements. So that is something we are doing, and so that is as far as the rolling stock is concerned. Signaling, we want to grow the portfolio significantly.
Right.
So we are actually, in the process of streamlining our operations, in the sense that, we had a lot of very, very old projects running for, years together, and we are, actively, formed a team, pursuing the teams to, close all these projects so that the organization's, bandwidth could be freed up to do more value-added work and get more contracts.
Right.
So these are two definite areas. On steel foundry, we are restructuring our geographical portfolio in the sense that, we would like the factory in Kolkata to focus only on export market,
right,
which is very good, very lucrative, because, in road system also a lot of investments are going in. And we are the only certified AARI supplier from India actually for the steel foundry material which gets into railways.
Right.
So, and the Ulla plant would be focused on the basic, castings, etc. for wagons.
Right.
Then on bright power and the railway electrification and EPC business, I already told you, we are now looking at getting more and more smaller contracts to build the order book and also to build credentials. We are very focused on getting more work in the metro space, typically the ballastless tracks.
Right.
And we are participating in a lot of tenders. So we want to significantly, we have corrected the order book in terms of, on the EPC side, in terms of old contracts going out of the system and trying to get into new ones. So there will be a lot of focus for the next financial year to build a very strong order book for ballastless tracks and signaling business. As far as the rail EPC business is concerned, we are also planning to increase our order book size for the hydromechanical equipment and bridges and structurals. That division also, we've been rationalizing the portfolio, getting rid of old contracts,
right,
in terms of finishing them and clearing up things. So, the cleanup has been quite good, and we have been able to close a lot of old issues.
Right.
And going forward, I would say in the EPC business, what we build as order book next year would show in results, a year later. So the next year's focus is typically to build an order book of much in excess of what we currently have.
Right. So Ashish, one more question on the same lines you narrated very nicely. What are the preparation as organization you need to do in terms of, say, technological advancement or manpower or beyond the execution? I'm not going to execution, but in terms of building a working capital, because if you have large orders, you'll need a larger size working capital. So what are the 2-3 top priorities or company to go into the next level of technology? What are the areas you think is immediate priorities and which you are building up?
So let us look at the manpower. So we have a very good new team now. We have hired a lot of youngsters, and we are now reskilling the organization for future. So typically, industry used to deploy non-technical workers, most of them trained in-house, but now we are actively pursuing employment of engineers and diplomas on the shop floor, trying to change the product mix, trying to build a cadre of people who can do more technologically advanced products.
Right.
We are building a good design center now, and we already procured all the software which is required to design wagons. We are now in the process of strengthening our design cell, recruiting more people, even looking at the possibility of tying up with design houses, which could help us with support on new wagon designs. Right. Because the new wagon design policy of railways has been completely liberalized now.
Okay.
So, so we can actually design whatever I would not say whatever, but we can design good wagons, get them independently certified and put them on tracks.
Right.
So in terms of, this is one part in terms of the rolling stock in the steel foundry business, where we are strengthening design and research capabilities, because as things open up and liberalize, we should be able to leverage our design capabilities 3 to 5 years from now, because these capabilities would take time to build.
Yeah.
On the EPC side, we have had a very significant reduction in our headcount in the last 2 years. Close to 40% people have been rationalized primarily on account of closure of old projects. We are also trying to change the mix of people there.
Right.
In terms of the technical skills, we are looking at working with very good outsourcing partners.
Okay.
And move away from a typical labor supply contract situation.
Right.
So yeah, so those are the type of things we are doing. And these are important things to do, but the results should take time to show.
No, surely. All the best, Ashish, to you and your team.
Thank you so much. Thank you so much.
Thank you. We have the last question for the evening from the line of Tushar with Ratnabali Securities. Please go ahead.
And sir, still now we have some plan. So any development on the defense side, sir, or what we are foreseeing in next 1 or 2 years, sir?
No, we are still exploring options and opportunities, but there is no development on the defense side.
Okay, sir. As of now, sir, there is no development. So, sir, okay, now onwards, sir, then we are mainly concentrating on the rail EPC as well as the wagon side, sir. Is it right understanding, sir?
So, rail EPC, wagon manufacturing, then hydromechanical equipment and bridges, and also steel foundry business.
Okay, sir. Defense is not. Okay, so defense, sir, we are not really concentrating right now, sir.
Thank you.
Thank you. Ladies and gentlemen, again, if you have a question, please press star, then 1 on your telephone keypad. Ladies and gentlemen, again, if you have a question, please press star 1 on your telephone keypad. We have the next question from the line of Videsh Gandhi with Discovery Cap. Please go ahead.
Hi, sir. Given the large outlay for the capital expenditure expected in this sector, just wanted to understand how do you see the comparative intensity playing out in terms of profitability, in terms of margins going ahead? Because what typically ended up happening is the problem, obviously, with the government orders, every one, when people have extra capacity, people bid aggressively, and therefore, in general, the profitability of this industry has typically been hindered. So just wanted to understand how you guys are looking at this.
Thank you. It's a wonderful question. Actually, you are absolutely right. Industry suffering from a perennial, issue of overcapacity. And the order books that we are looking at right now for the entire industry, we should be able to come out of the situation. And I think, there should be healthy competition without actually, booking loss-making orders, which most of the companies are doing just to keep the factories on. So while we understand that, we can't be doing profiteering also. So I think the industry should see better and reasonable margins going forward because of higher order loads and better capacity utilization.
Got it. And so effectively, are you seeing on new orders which we are seeing, are we seeing a level of discipline happening from our competitors and ourselves, where new orders are being taken at reasonable levels of profitability?
So if you look at, the orders from private sector, so those orders have already been, handled differently by the industry, and because most of the buyers have their preferred wagon manufacturers. So these are all very long-term relationship-based contracts. So they behave very differently. But if you look at the Indian Railway orders, so the order book is large. The industry behavior is very different, and industry behaves more responsibly and try to make decent, not I would say try to make optimum profits. Because the order books are very, very small, so you can understand what happens. It's bloodbath. So I think I don't really anticipate a bloodbath going forward because the orders books from railways is expected to be quite large actually. Because the projection which railways has given is 102,000 wagons to be procured in the next 3 to 4 years. That is something which railways has never done, and that should consume almost the entire capacity of the industry.
Good. So the question is then how much, if you could maybe outline for us broadly what the overall capacity of the industry would be and in terms of like annual capacity?
I would say industry capacity, keeps, there's a lot of capacity which can be turned on overnight, but the confirmed capacities are close to 32 to 35,000 wagons per year, which includes everything, both the private and public sector. So if the railway orders are going to be in the range of 25 to 30,000 wagons, then, you're almost talking of almost a full capacity utilization, plus the private sector orders, which normally are in the range of 2 to 3,000 wagons minimum every year.
Got it. Understood.
Sector.
Thank you. Our next question is from Tushar with Ratnabali Securities. Please go ahead.
Yeah. Hi, good afternoon. Sir, could you please give some guidance on the signaling and AFC division? Like, what are your plans going forward and what is the current situation right now?
Okay. So, on the AFC front, which is the automated fare collection system, we are currently executing one order in the Mumbai Metro. We are now, looking at we are now planning to build an order pipeline next financial year for the AFC business also, because a lot of new metro projects are coming up, and typically AFC orders are awarded, after the construction is almost complete, because you have to, fit it on railway stations and the metro stations and other stuff. So we will be targeting, to get some orders next year. So these are all orders based on competitive bidding. It's difficult to put a number on, what it's going to be. But the overall market size for AFC next year should be in excess of 1,000 crores. That will be the tenders on which will be bid. That is one part, which is the AFC. On signaling, we typically like to do large EPC contracts, like the DFCs and all. So currently we're executing the last phase of the contract in DFC, which is going to take another 2 years to complete. And we have taken smaller orders, in various divisions of railways. And typically, we are looking at right now, in absence of very large EPC work coming up, we are looking at more and more orders which are typically spread across 12 to 18 months, so that we are able to complete these orders faster, turn the cash around, and then be ready for the opportunities as they come for larger contracts.
Okay, sir. Sir, that was great. That was a nice explanation. Sir, could you please also elaborate on what our EPC division, like, what are the current major projects going on and what we have in our order book going forward?
Okay. So if you look at the major projects going on right now, we are currently doing the Balaswest track laying for Bangalore Metro. Then we are doing the signaling and telecommunication network in the Western DFC. There is a project going on for track laying on the Eastern DFC. We have 2 projects in Bangladesh. So these are the larger projects. And then we have a lot of small projects, which are typically 50, 60, 70, 80 crores type of projects. So, that is how it looks like. Plus, we have railway electrification projects. These are again smaller stretches, 50 kilometers, 100 kilometers. We also got into the maintenance of the OHE systems now. In fact, we are one of the few companies in India who can actually have the credentials to maintain a complete circuit of more than 300 kilometers today. So that is one sector we are looking at very, very aggressively, which is to get into these railway services of maintenance of OHE tracks and the network equipment.
Okay. Okay, so just one last question. Like, could you just give a breakup as to our receivables? Like, how much of the component is of government or government companies or agencies, and how much of it is of private players?
Almost all our receivables are from government companies. Almost all. Very minuscule from the private sector players.
Okay. Thank you so much.
Yeah, most welcome.
Thank you. Our next question is from Subrata Sarkar with Mount Intra Finance. Please go ahead.
Yeah, hi. Could you please elaborate on the new wagon design companies, companies' projections with that, or what the company plans to do with it? I'd love to.
Okay, thank you. So, see, the earlier process was that the entire design process was tied up to RDSO and had a very cumbersome and an elaborate process of approvals. And typically, a design approval could take, anything between 2 years to 4 years, maybe 5 years also. Now, the liberalized policy, a wagon manufacturer today could design a new wagon and get it certified through an independent safety assessor. So that is there's a significant change which would improve the pace at which designs would happen and get approved, and we would be free to get new international designs or adapt more international designs to the Indian conditions. So that is a significant change in policy.
So, do you see any particular space or particular customer which you will be able to cater to now, which you weren't able to cater to earlier?
So I'll give you a very small example. For example, if you look at the movement of cars through trains, these auto carriers.
Yes.
Now with the product mix changing significantly, to 58% SUVs. So it's not possible to transport two vehicles on top of each other because you need a taller wagon design which doesn't exist in India. So now, we've been trying to do this with a lot of people earlier. Now we can hasten up the entire process, and this is something which is a latent demand in the market. That is one. Second is, various types of wagons for specialized commodities like slag or would say fly ash, covered wagons with rotary tipplers. So a lot of possibilities would be there, which will improve the efficiency of operations of our customers.
Okay. So just one last question related to this only. Let me see that into. So let's say you design a wagon. Do you own the IP to it, or is it exclusive to you, or is it open for all to make henceforth?
See, currently the process is that the IP is jointly owned by RDSO and the company which is designing, and anybody applying to use the design pays royalty to both RDSO and the inventor.
Okay. Thank you so much.
Most welcome.
Thank you very much. That was the last question in the queue. If there are no further questions, I would now like to hand the conference over to Mr. Ashish Gupta for closing remarks.
I would like to thank all the investors first for supporting us for the rights issue. Thank you so much to all the investors. It was very useful. It was a great confidence booster for the entire organization and the employees. So from our promoters, from the management, heartfelt thank to all the investors. That is one. Second is, we are working very hard as an organization to improve operations and improve execution. And, going forward, as we look at the markets and the spend on infra, I think the key thrust would be to improve the capability to execute and, reduce cost and improve efficiency. And that is what your company would be focusing on. Thank you so much.
Thank you very much. On behalf of SKP Securities Limited, that concludes the conference. Thank you for joining us. Ladies and gentlemen, you may now disconnect your lines. Thank you.